Hey everyone, welcome back to Corporate Decoder, the place where we uncover the secrets hidden in plain sight. Today, we're diving into a report that might leave you scratching your head or maybe even reaching for your wallet. We're looking at a filing from a company called Our Bond Incorporated. Now, the name itself might sound a little optimistic, right? But as we'll see, the real story here is about borrowing, not just bonding. This isn't about their day-to-day operations, but a specific borrowing event that happened on the 17th of February 2026. This is a current report essentially telling us about a significant event, and the big event here is a material definitive agreement, which in plain English means they signed a really important contract. So, Our Bond Incorporated, which is registered in Nevada and trades on the Nasdaq under the ticker OBI, is telling us they've taken out a loan. This isn't just any loan though. It is a promissory note issued to a company called Ascent Partners Fund LLC. This promissory note is for a principal amount of $526,315.79. Now, here is where it gets a bit tricky. They didn't actually receive that full amount up front. They issued it with what is called a 5% original issue discount. What that means is they sold the note for less than its face value. They paid $500,000 to get this note, which has a face value of over $500,000. So they effectively borrowed $500,000, but their debt is recorded as the larger amount. The interest rate on this note is 10% per annum, which is pretty standard for a business loan. But this loan has a short fuse. It matures on the 30th of June 2026. That means they have to pay it all back, principal and interest, by the end of June in 2026. That's less than 4 months from the date of this filing. They do have to make monthly payments of the interest that builds up on the first day of each month. But the bulk of the payment, the principal, is due at the maturity date. And here is a crucial part. They are required to use the money they raise from selling any of their own stock or other securities towards paying off this note. This tells us they likely don't have enough cash reserves to pay it back on their own and are counting on future fundraising to do so. What happens if they can't pay? Well, the interest rate skyrockets to a whopping 24% per annum. That is more than double the original rate. Plus, any late payments will incur a late fee of 10% of the late amount. That is a huge penalty and shows how serious they are about timely payments. The list of what is considered an event of default is pretty extensive. It includes not paying on time, not following the agreement's rules, defaulting on other debts over $150,000, and even a change in control of the company. A change in control could mean a new owner takes over, or the management team significantly changes. This means that if something big happens internally, it could also trigger a default on this loan. The company has also checked a box indicating they are an emerging growth company. This means they have certain regulatory benefits, like being able to delay adopting new accounting standards. This is often seen in smaller, newer companies. They have elected not to use the extended transition period for complying with new or revised financial accounting standards. This suggests they're aiming to be compliant with newer rules sooner rather than later, which could signal a desire for greater transparency or preparation for growth. Now, this filing is an 8K, which is for current reports. The real meat and potatoes of a company's financial health usually come in their 10Q or 10K filings. But this 8K tells us something important about their financial situation right now. They needed $500,000 and they needed it fast, with a clear plan to use future stock sales to pay it back. Looking at this filing, Our Bond Incorporated is essentially telling us they are in a tight spot financially. They've secured a loan, but the terms are aggressive, and they're relying heavily on future fundraising to meet their obligations. The high interest rate in case of default and the broad definition of default events paint a picture of a company under pressure. The fact that they are an emerging growth company and are issuing this type of debt with a discount suggests they might be struggling to access traditional, more favorable forms of financing. They're essentially paying a premium for quick access to cash. The short maturity date of the note is also a significant risk. If their future fundraising efforts are delayed or don't generate enough capital, they could quickly find themselves in default, facing those very high penalty interest rates. This filing signals a company that is actively trying to manage its cash flow by taking on debt with some very serious strings attached. It's a move that can provide immediate relief, but carries significant risk if future plans don't materialize as expected. What is your take on Our Bond Incorporated's latest move? Do you think they can pull it off and pay back this loan? Let me know your thoughts in the comments below. If you found this deep dive valuable, please hit that like button and subscribe for more corporate breakdowns. And don't forget to join our Discord community. The link is in the description. Thanks for watching, and I'll see you in the next video.